Right, good morning. Welcome to the week, 10th of August. So, let's have a look around the markets, talk about Friday. Of course, it was payrolls day. I had billed it as perhaps potentially the most important day of the year almost, and it spectacularly failed to live up to expectation. So from a trading point of view, absolutely not what we were looking for. Just as a reminder, you'll all know, here's the chart. The headline NFP number came in just below expectation at 215,000. We had expected 225, but marginal increases. So we were 10,000 less than expected for July, but they actually added 14,000 when you add it up. Very small upward revisions to the prior 2 months. So we added 14,000 to June and May, and so actually net we were 4,000 jobs better off. These numbers, these differences, 4,000 is basically zero. It's negligible. So this data came in bang in line, and this is why, as a trading event, it was not ideal. On the wage growth front, again, it was in line on the month, so 0.2% wage growth, plus 0.2 that is. And then on an annualised basis, it came in just shy of expectation, but an increase on the month before. So the month before, so June, we saw annualised wage growth of 2%. For July, we were expecting plus 2.3%, but it actually came in at plus 2.1%. So the net result of all of this was actually, it really didn't alter, it didn't really matter. Whatever your opinion was in terms of your expectation as to when the Fed are going to hike rates, whatever your opinion was before Friday, it probably hasn't changed. And actually there's been very marginal movement on the pricing in of this in terms of the percentage likelihood of a September hike. It did actually increase. So before Friday, there was a 50% chance of a rate hike in September's Fed meeting. And then after payrolls, that turned to become a 54% chance. So I guess, notably, we now have a majority of people, or markets at least, expecting a hike in just over 4 weeks' time. If we just have a look at some of the... I've got daily charts here just to start with, just to look at the kind of bigger picture. And, I would say with this US equity situation, nothing's really changed. You could point towards last week and say, well, actually, 5 sessions, 4 of them were negative. So we had 4 down days out of 5 last week. The only notable trend reversal move came on the Wednesday, but ultimately we finished in the end on Friday pushing down. We're really just in the middle of this range though, so we've still got kind of the status quo here. Looking at the euro dollar, last week was reasonably flat. In fact, we finished with a bit of dollar weakness. I'll zoom in on some of the shorter time frames in a second, but you might say we had a bit of dollar weakness on Friday, despite the fact that percentage likelihood of a rate hike went up marginally. In the end then, I guess euro dollar finished flat, just up on the week marginally, but you can still see that we're in this kind of downward trending scenario still. If you look back over the last couple of months, still what remains to be the key platform here, the key support is May and July double bottom down around 108.20. That's the key level. Whether we get there this week, we'll see. We have got some decent data, I'll talk about that later. But we're going to need 160 pips to the downside just to get to that price. So we'll see. Maybe this week that is not quite on the agenda. But as we track through the summer, we expect it to be. In terms of bond markets, the Bund has been, had a good sort of month really, from mid-July's low right the way through to the beginning of August. But then last week we kind of stumbled a little bit. First part of the week, some decent downside, then into the end of the week we recovered, and particularly the Bund, perhaps the surprise mover on Friday, with some pretty decent appetite on the upside. But I would say the best chart, and perhaps the most obviously notable mover on this screenshot, is the bottom right hand corner, and it's crude oil, and it just continues to get savaged, would be a not too strong a word. Again lower this morning, breaking Friday's low, consistent downside last week again, breaking the key July low and just adding another $3 to the downside. Importantly, if I just make this chart a touch bigger, then what we've tested this morning is the end of January low. This is on the continuation chart. 43.58 was the 29th of January low. That's today's low. We've got one more barrier to test on the downside. Of course, we haven't broken this January low yet, but if we did, then we, next stop, low of the year, $42. But we shall see. We've bounced a touch off this January low so far. I got a 30% reading here. That's the move from the May high down to this morning's low. That's a 30% drop. Of course, most of that coming just in the space of the last 6 weeks. So oil obviously continuing to get pressured. We've got a very pronounced, very steep downtrend in play. And as it stands, there's no sign of that reversing. We've had upward movement on production out of territories like Saudi Arabia, like Iraq. We've then got the Iranian situation where sanctions might get lifted towards the end of the year, which might bring online an extra 500,000 barrels, if not a million barrels per day. So you've got upside pressure on output, exacerbating the oversupply situation. And then you look at the Baker Hughes rig count and what happened. Actually, we got some news overnight which perhaps explains a little bit this move we've seen this morning. I've got a very, very interesting chart here. Quite remarkable chart, in fact. This will be chart of the week. Forget chart of the day. This might even be chart of the year, actually. This is looking at, so the red line is the current year, 2015 Baker Hughes rig count. So how many oil rigs are operational in the US? The grey bars, that's last year, 2014's Baker Hughes rig count. And so as we hit, as we hit the turn of the year, this thing started to collapse. And as you can see, it bottomed out, so far bottomed out in June, around, through June, it flattened off. And what's happened since is we've been having marginal increases. Now, I know on this chart, I say marginal increases, we're still slap bang at the bottom of a sensational collapse here in rig counts. But we've actually had 4 increases in a row. So this is Baker Hughes rig counts on the up. This is during the period where we've had another huge 30% sell-off in crude prices. So I think this has been quite surprising. It's surprised most. And I think the rig count number we got over the weekend showed an increase. This surprised people. This is why price of oil overnight continues to be under pressure. Plus you've got some more weak data out of China that I'll talk about in a minute. But yeah, just a remarkable chart. And I would say what's more remarkable than anything else is despite this huge collapse, we had 1,900 rigs in operation in December. And here we are in January, we've got less than half of that. So, and the most surprising thing is the output, crude oil output in the US has actually barely changed. So they're operating with half the number of rigs, but continuing to pump around 9.4 million barrels a day. So this is quite an extraordinary picture, but the touch of upside we've seen over the last few weeks, despite a 30% drop in oil, tells us that there is still pretty remarkable resilience in the shale industry, continuing to operate under huge revenue squeezes as price collapses. So this is why oil's been under pressure today. Now let's zoom in a touch and just look at the payrolls figure. We won't spend long on this. Let's just go to a couple of 1 hour charts here. Let's look at the euro dollar and the S&P. If I just make these charts a little bigger. Then what happened on Friday was we had a bit of a chop fest off the data. We didn't move much. Then we had a little bit of a push up to test the earlier high, so around 2082, the overnight high. That's where we turned, and actually in the end we had a decent sell-off into the European close, bottoming out down around the low point that we had back on the 28th of July, just shy of 2061, before a bounce into the close. A lot of this move in the end, I would say on Friday, came as a result of the oil price drop. It seemed to be the energy sector that got certainly underperformed on Friday as oil dropped into the new lows. Going into the European close, we broke below Thursday's low, trading down below $44 in the end, and the energy sector got squeezed. And maybe you could say the chances of a rate hike in September marginally went higher, but I don't know. Friday's after the payrolls number was a bit of a write-off in terms of trading opportunities because of the nature of the data, which was basically in line with expectation. In terms of the euro dollar, well, to start with, we got dollar strength, but then it all got given back, and actually we just about nicked a new high just after the European close, a new high for the day, and things have settled and we're still trading around that price point. So really confusing price action on Friday, and that's because the data, it wasn't confusing. It just didn't give us any new information, and so markets found it really difficult to interpret it. And in the end, I guess you could say we got some dollar weakness, even though for a decent period we had dollar strength. Just seeing actually the S&P's under a bit of pressure here, just trading down through the low. Well, not the low of the day yet, but certainly this is the lowest point since 1 a.m. last night. So payrolls, difficult event, and really didn't tell us much more. And so we kind of maintained the status quo in that it's still roughly a 50-50 chance of a Fed rate hike in 4 weeks' time. Let's talk about the data overnight. So we've had some important data out of China, and it's bad news, except stocks rallied pretty strongly. So it's like bad news is good news. That's the mindset in China at the moment. Bad news on the economic data front means more likelihood of more stimulus from the government and the central bank. So actually equities lifted off the back of some very weak export and import data. Here's the exports chart for China. And it's a bit confusing, this, because this is the July print we had announced over the weekend. So it's the highest for the year. So you might say, well, hang on, that's good news then, isn't it? But actually it's more about annualized growth. And, well, in this case, the lack of it. We actually got a drop. So if you compare it to the year before, July the year before, then we are 8% worse off. So we got industrial production. No, we don't. We've got Chinese exports, 8% lower than last year. Okay. Now, we were expecting a drop on the annualized figure, but not of 8%. We were expecting a 1.5% drop. Just look at the 10-year. I want to show you the 10-year long-term chart here to kind of get this in a bit more perspective. We often get a lot of volatility on this data. The Chinese sort of Lunar New Year, sort of in January, February each year, kind of disrupts this. This is why you get these major kind of surges to the downside. But you could still say we're cycling higher. It's just that it's probably the case that the figure, are we going to get a new high for this trend in the second half of 2015? And I would say that arguably that's not going to happen. I think you may well have seen for now at least, maybe, who knows, maybe forever, but you might have seen, that's a big comment, but you might have seen the export situation here peak for the near, even medium, even long term, very much depending on, of course, the Chinese economic situation, but then more broadly in the long term, looking at the shift away from a manufacturing and export driven economy towards a consumer driven economy. So notably bad export data from China last night. Now if you look at the import side, well, again, we got a new high for the year, but again it was down on the year before, so 8% drop as well here, which was more in line with expectation actually. So you got weak export numbers and weak import numbers. The weak export numbers, that points towards a weak global economy. The weak import numbers, you could say, points towards a weak internal consumption story in China. And so both sides are weak. Net, you actually got an increase in the trade surplus figure, but weak data out of China last night. On the inflation side, we got the PPI, the producer price inflation number, coming in on an annualized basis below -5%. That's the 40th month in a row of negative PPI numbers, and this one, the reading for July, was the most negative of all. Of the whole 40 months, this is the biggest negative print. So these figures still continue to add fuel to the fire of those concerned about China's growth. But it's, we've got the central bank and we've got the government in full stimulus mode, and so at the moment, from a Chinese equity point of view, it's very much good. Bad news is good news, because it means in the near term we're probably going to get more stimulus. But maybe this is where, that's certainly been a part of the oil price move as the Asian session began. So the Baker Hughes rig count, weak data out of China, that's why oil was lower at the start. We were trying to reclaim this, and we're just kind of moving up above Friday's low at the moment. But equities on the back foot in the US. In Europe, if we just go to a 1 hour chart, then we're reasonably flat. Sorry, no, we're not. We were flat when I started speaking, so we had a decent move, and we're below Friday's low here on the DAX. So just a bit of weakness at the get-go, at the beginning of the week. So that's a bit of an update on what's been happening in terms of payrolls review, in terms of China, and how we shape up for the week. So let's just talk about what we've got this week. We've got plenty of data to be looking at and monitoring. It's just unfortunate that none of it's today. Let me just show you the data calendar for today's session. So there's really, sorry, let me just get this screenshot set up properly. So let me put this back into the picture. So we got, some Norwegian data in 4 minutes' time. This isn't going to move anything, of course. We've got an EU Centix investor confidence number at 9:30. That's not a big number either. Greek industrial production. We've got a German 6-month T-bill auction. Portuguese trade balance. None of this stuff is really that interesting. Maybe the German T-bill auction. We had a Bobble auction. That's the German 5-year bond last week, where they were trying to sell 4 billion euros, but only managed to sell about 3.2 billion in the end. So suffering a bit, and maybe that helped with some of that Bund movement that we got last week. But obviously yields exceptionally low still, and maybe demand just suffering as a result. But we'll see. This T-bill auction's coming at 10:30. But really, in the afternoon, probably the most important event might well be Lockhart. So this is the first Fed speaker since payrolls. So it'll be interesting to see if he's changed his tone. It's unlikely, because of course the data was in line. So Lockhart's been a little bit hawkish, I should say. And so it'll be interesting just because it's the first Fed speaker since the payrolls data. But actually his comments are more likely, well, we'll see. He's speaking twice today. We might get some comments at 2 o'clock, but he might save his monetary policy comments until what's considered to be the more important speech in Atlanta, which is later on after the European close. So this is the lineup for today. Not that interesting. And on the earnings front, we're pretty much done and dusted on US earnings season. We've had about 450 companies report in the S&P. The hit rate at the moment on the beats, earnings per share beats, those that have delivered earnings per share or profits above expectations, is 71%, which is actually, it sounds like a lot, but it's actually normal. In fact, it's probably slightly below average, that. But the weak figure has been those number of companies beating on revenue forecasts, and it's actually 49%, which is notably bad. But earnings season is basically done and dusted. So today not that interesting, and often Fridays following Monday following the payrolls Friday can often be a very quiet affair. It's always the case. You get virtually no economic data on that day. And so we'll see what happens, but you might see markets being pretty quiet for large parts of the session. But we do have some interesting data coming for the rest of the week. Just a very quick overview in terms of the highlights. So tomorrow we get ZEW, Economic Sentiment Survey from Germany. This is important data. We get Italian CPI. We've got some small business optimism numbers. non-farm productivity and unit labour costs and wholesale trade data out of the US. On Wednesday, more important data out of China with retail sales, industrial production. We've got some Japanese inflation and industrial production numbers as well. We get some the UK employment report. We get Eurozone industrial production. We also get the JOLTS job openings numbers from the US. Okay, so tomorrow is definitely a busy day. Thursday's kind of a big one in that we get preliminary inflation numbers from the Eurozone, including Germany and France. That'll be important. We also get the minutes from the ECB meeting that was 3 weeks ago. But perhaps the most important data of the whole week comes on Thursday with US retail sales. Yes. Actually, no, is that Wednesday? Sorry, on Wednesday we get US retail sales. On Thursday, jobless claims, as usual. But we also, so Thursday a little bit lighter, but then Friday we've got Q2 GDP figures from the Euro area. We get also the Eurozone final reading on CPI for July. You get some French figures in there, but then from the US you get PPI data, industrial and manufacturing production, University of Michigan consumer sentiment readings. So it's plenty of data this week. It's just really none of it is today. Okay, so bear that in mind when you're trying to judge the scale of likely reaction across assets today. It might be a much quieter affair. The only other thing to update you on is Greece, so we might get a bit more Greek headline news as we go through the week. Apparently, some positive progress made on the bailout situation. Not that you're really seeing this feed through in any positive way on European equities. I mean, you might say that these equities gapped and opened higher, so perhaps that was as a result of the positive developments on Greece over the weekend. This is where apparently they're close to a deal. Apparently they're going to get a deal agreed and Greece is going to vote it through Parliament by the end of the week. This is the news, but I would say, obviously it's good, it's positive, it's definitely more positive than the negotiation process we've had for the rest of the year, but there's still some uncertainty on it. We still need the IMF to be involved in this. We still need maybe some debt restructuring that needs to be as part of the package. At the moment, all we've heard about is more discussions on cutting spending, on reform, on Greece putting 50 billion euros worth of assets into an independently run privatization fund. This is the kind of stuff they've been talking about. I haven't heard anything on really debt restructuring yet, and that's the roadblock in my view. So we'll see, but certainly it looks like some decent progress on Greece's 3-year bailout program. So there'll be more news on that as we go through the week. Okay, so that's it for now. Equities on the back foot. Oil's trying to lift, having had another sort of multi-month low as the session got going last night. All right, guys, enjoy the week. Thanks a lot.